Today's highlights. US debt looms, on-chain bottoming out. Is it time to buy the dip? The US SEC draws a line. Four asset classes are clearly not securities. Will the bull market logic change? When payments become loans, how much of the traditional financial moat remains? Friday, March 20th, BTV Chinese channel Where is the Coin Chain? I'm Lucia, and it's time to meet you all again. First, let's look at the most important data headlines in the crypto world over the last 24 hours. In the current market, money is too expensive and the US dollar is too strong, so the crypto world naturally backs down. 10-year US Treasury yields are around 4.3% and 30-year yields are nearly 5%. The US dollar index has also stayed above 100 for a long time. This combination is like saying the world is shrinking. Money is becoming scarcer and more expensive. So the first reaction of capital is definitely not to rush into a roller coaster asset like Bitcoin, but to sit back and collect interest instead. Let's look at history, which is actually very telling. In the two cycles from 2017 to 2018 and 2021 to 2022, as soon as interest rates rose, Bitcoin's sentiment volatility intensified, or it even pulled back directly. This chart is also very intuitive. When yields go up, Bitcoin is very easily suppressed. What's even harder now is that inflation is quite stubborn. The Fed says it's not being aggressive, but its grip is actually very tight. The market's fantasies of rapid rate cuts have been repeatedly debunked. Plus, rising oil prices and geopolitical tensions are constantly adding pressure, telling everyone that high interest rates might last even longer. In this environment, money is more expensive and liquidity is tighter, so risky assets are naturally being suppressed. And Bitcoin shouldn't dream of going it alone either. So, before the macro environment eases, it'll likely fluctuate or even follow a suppressed rhythm. The current on-chain state is not expensive, but don't expect to find any huge bargains either. The MVRV ratio has dropped to around 1.3. Historically, this position is okay and not expensive, but it's not at a rock bottom price yet. If you look at the crazy stages of the previous bull market between 2.0 and 2.5, it's clearly much calmer now. It's also very clear on the chart, sliding all the way from 2.4 to 1.3, with the price falling from nearly 120,000 to around 70,000. This wave is actually about flushing out leverage and cooling down the sentiment. The external environment now features high interest rates and a strong dollar, so capital is afraid to rush in. Even gold, which should be a safe haven, hasn't strengthened. This Bitcoin rally is more about capital shifting positions internally, rather than a collective move towards safe havens. The on-chain data is also very honest. Long-term players haven't really moved. The ones actually selling and causing volatility are short-term players. So, in this second stage, it's more like the market taking a breath and finding its footing. It's not a peak, nor is it the time to buy the dip. It's just a period of slow recovery and price discovery. So where do we go from here? It still depends on when money starts becoming cheaper. Actually, the current market is in a state where you can still make a profit, but it's no longer easy to do so. I think everyone feels this way. Bitcoin is now around 71,000, while the average on-chain cost has reached a price of around 54,000. This shows most people are still making money, but the upside isn't that large. If you look at history, you'll find it's quite interesting. Like during the pandemic in 2020 and the bear market of 2022, whenever the price approached this cost line, the market basically entered that kind of stagnant sideways period. And this time, it's starting to feel a bit like that again. Looking at the profit and loss structure, about 59% of people are in profit, while 40% are at a loss. This structure is very telling. No panic, but no excitement either. Everyone's starting to cool off. The most obvious sign is fewer trades, speculative capital is pulling back, and the market's heat is dying down. In fact, even the retail investors aren't as eager to jump in anymore. This stage usually isn't the peak, but rather the market entering a repricing phase. So right now, it's not about who has the flashiest moves, but who can handle the boredom. Once the market has completely cooled down, that's when opportunities will actually start to emerge. Please like and hit the bell icon. We'll monitor news for you 24/7. This channel takes a macro perspective, providing 15-minute deep dives to help you quickly grasp major changes in the digital asset space and boost your understanding. Now, let's look at the news. Changes in US regulation aren't essentially about controlling crypto, but about redefining the boundaries of the financial system. Since Paul Atkins took office, the SEC has started to clarify a core direction. It's not about a total crackdown, but about drawing lines, making it clear once and for all what is a security and what isn't. At the same time, it's pushing new structures like on-chain securities and stablecoins into the compliance framework. So what does this mean? Simply put, it's a major shift in the US from regulatory uncertainty toward rule certainty. And once the rules are clear, real big money and the traditional financial system will enter the fray. The essence of this round of changes is bringing crypto assets from the fringe back into the mainstream financial system.
The US SEC has released its latest interpretive document clarifying the scope of federal securities laws application to crypto assets and coordinating a regulatory framework with the CFTC. SEC Chairman Paul Atkins stated that most crypto assets are not securities themselves. He also proposed a clear classification system covering categories like digital commodities, stablecoins, and digital securities, while defining regulatory boundaries for activities like airdrops, staking, and mining. CFTC Chairman Michael Selig simultaneously stated that both parties will unify their regulatory logic, ending long-term uncertainty. This move is seen as the first time the U.S. has systematically defined the attributes of crypto assets.
Our interpretation, which is grounded in existing law and informed by extensive public input, establish 4 asset categories that are not deemed to be securities. So digital commodities, digital collectibles, digital tools, and payment stablecoins under the DINC Genius Act.
The SEC has approved NASDAQ to move forward with tokenized securities trading, allowing certain stocks and ETFs to be traded and settled as on-chain tokens. Initial targets include Russell 1000 index components and S&P 500 related ETFs, while settlement will still be completed through the Depository Trust and Clearing Corporation system. This mechanism enables a dual-track system for traditional securities and on-chain assets. NASDAQ has previously submitted a rule change application to support this model. Additionally, exchanges like ICE are also developing on-chain securities platforms, showing that traditional financial institutions are accelerating their entry into the asset tokenization space.
Looking at it now, the signals are actually very clear. On one hand, regulators are defining boundaries, while on the other, exchanges are building infrastructure. This is a classic case of policy leading and the market following. In the past, the market was actually stuck on one issue, not knowing which assets could be used and which couldn't. And now, the SEC has directly provided classifications while allowing NASDAQ to conduct on-chain trading. This is like opening up a brand new market space, from the controversy over stablecoin yields to the follow-up on the Clarity Act, and the coordination between the SEC and the CFTC. Behind this series of moves is actually the construction of a complete digital financial system. Once this system is up and running, on-chain securities, on-chain bonds, and on-chain capital flows will all become mainstream. The logic of the crypto market will shift from a speculative market to financial infrastructure. Over the past 10 years, what cryptocurrency has done is essentially just one thing. Today, Lucia is going to talk about it. It's moving money from A to B faster and at a lower cost. But this isn't the ultimate form of payment. The core of true financial infrastructure has never been transfers, but credit, that is, the lending system. Traditional finance is powerful because you can use future money to consume today. For example, the credit cards, mortgages, and consumer loans we use. That's the ultimate leverage of currency. Now, this logic is slowly being transplanted into the crypto world. Stablecoins are the first step. They give cryptocurrency a value anchored in reality. The next step is to let these stablecoins truly enter our daily lives. They can be saved, borrowed, or even sent to your Alipay account. Crypto payment is no longer a game for insiders. It's merging with traditional finance. It's becoming the infrastructure that runs alongside traditional finance.
The total global supply of stablecoins is between approximately $280 billion and $320 billion. Visa has already participated in stablecoin settlements, with a scale reaching billions of dollars. The circulation of PayPal's stablecoin, PYUSD, is about $1 billion. Meanwhile, regulatory frameworks like the EU's MiCA, Singapore's MAS, and Canada's MSB are gradually being implemented. Licensed institutions are becoming key nodes connecting on-chain assets with the traditional financial system. The ability to move stablecoins in and out is becoming the core competitiveness for crypto payments to go mainstream.
Stablecoin money is safer money, and stablecoin money will become the most desirable money to borrow, and credit markets will develop all around the world around borrowing and using this form of money.
The crypto payment platform MiPay provides stablecoin-based fund transfers and global remittance services supporting USDT deposits on the TRC20 chain and holds a Canadian MSB financial services license. Regarding fees, top-ups are about 1.8% and transaction costs are 0.21 euros plus 0.1%. As the number of licensed institutions grows, compliant withdrawal channels are becoming vital infrastructure connecting on-chain assets with the real financial system and a key standard for users choosing payment tools.
So let's take a look at products like MiPay. The significance of these products isn't really in their functions, but in their position. It sits at the interface between on-chain funds and real-world finance, acting just like a bridge. In the past, crypto assets were mostly limited to things like trading and investment. But now, as compliant channels are established, funds are starting to have real liquidity. This reflects a phase change in the industry, moving from wild growth to structured development. From lending systems to payment channels and compliance frameworks, every piece of the puzzle is falling into place. When this infrastructure forms a closed loop, crypto finance will no longer be just an alternative, but a full part of the global financial system. OpenAI grabs the entry, XAI grabs distribution, and Amazon grabs computing power. In this AI power struggle, who will come out on top? Funds flow on the chain, but power is decided in Congress. So who really calls the shots in this market? We get AI news every day, but the competition behind it is becoming clearer, escalating into a battle for three types of power. It's not about whose model is smarter, but who controls the entry, distribution, and productivity. Today, Lucia will break it all down for you. First, let's look at OpenAI. OpenAI is working on an entry monopoly, bundling ChatGPT, Codex, and a browser into a desktop super app. Essentially, they're fighting for the super entry point of the operating system. Because in the AI era, whoever controls the traffic controls the user's attention. Amazon founder Jeff Bezos is taking the fight to the base layer, pouring $100 billion into manufacturing and computing to control productivity pricing. Put these three together, and you have the architecture of a complete AI empire. Entry determines users, algorithms determine traffic, and computing power determines the ceiling. Future competition won't be about products, but about who can control the entire chain.
OpenAI is pushing a desktop super app integrating ChatGPT, Codex, and the Atlas browser into a single entry point to solve product fragmentation. Led by President Greg Brockman, it also strengthens enterprise competition against Anthropic. Codex has over 1.6 million weekly active users. AI is shifting from a tool to a platform entry point. I don't think we're disentangling. Look, I will not pretend that there are no misalignment or challenges. Obviously, there are some. But on the whole, I think it's been a tremendously positive thing for both companies.
Elon Musk's XAI is taking a different path by open sourcing the X recommendation algorithm, essentially fighting for information distribution rights.
Elon Musk is pushing for deep integration between XAI and X and open sourcing parts of the recommendation algorithm to boost transparency and developer engagement while strengthening information distribution. Currently, XAI is valued at around $80 billion, and it continues to expand its computing power and data. Musk claims he will catch up with OpenAI and Google this year. AI competition is shifting from models to data and traffic control.
All right, so if we put these three things together, the logic becomes very clear. Altman is actually fighting for the entry point, Bezos for production, and Musk for distribution. These are the three core power structures of the AI era. Whoever controls the entry point controls the users. Whoever controls the algorithm controls attention, and whoever controls computing power controls the cost and the ceiling. The essence of this round of competition has shifted from a software battle to an industrial scale war. That's why you see capital scales getting larger and larger, because this is no longer about startups, but a fight for infrastructure. In the future, those who truly survive won't be those with the strongest models, but those who can integrate entry points, traffic, and computing power. If people are still using bull and bear markets to explain the crypto market, they're already a step behind. Today, Lucia is going to take you through another perspective, and that is politics. After the last US election, as you might have seen, ETFs were approved, stablecoin legislation began, and regulatory attitudes started to shift. And this recent surge was actually driven by policy expectations. Now that the midterms are here, the crypto world is dropping the act, entering the fray with cash to start playing the game. Simply put, whoever can influence policy can set the price. Power in this market is no longer on the chain, but in Congress.
The 2024 US election became a turning point for the crypto industry. Political investment from the crypto industry exceeded $100 million, with Coinbase and Ripple as the main sources of funding. Organizations like Fairshake invested a total of about $130 million, with a win rate of over 80%. After the election, ETFs were approved, stablecoin legislation moved forward, and regulatory attitudes shifted, moving the crypto industry from suppression toward institutionalized development. Political figures began making public statements and adjusting regulatory directions.
This afternoon, I am laying out my plan to ensure that the United States will be the crypto capital of the planet and the Bitcoin superpower of the world, and we will get it done. I will fire Gary Gensler and appoint a new SEC chairman.
In this year's U.S. midterms, crypto political funding exceeded $200 million, with a total impact of nearly $270 million, a significant increase from the $130 million in 2024, focusing on key seats. Meanwhile, Citi lowered its Bitcoin target price from $143,000 to $112,000. As legislative progress slowed, the market remained volatile, and capital flow was affected by policy uncertainty.
Actually, if we look at these two rounds of elections together, the logic is very simple. Last time it was about setting the direction, turning crypto from being suppressed to being gradually accepted. This time, it's a race of speed, whether to give the green light or keep stalling. The market isn't short on cash at all right now. The money is just sitting on the sidelines waiting for a signal. Once the policy loosens up, capital won't just trickle in, it'll flood in and pull the whole market up instantly. That's why you're seeing the crypto world starting to dive headfirst into politics now. Actually, this market stopped being about tech a long time ago. It's about who can better influence the rules of the game.
On-chain data shows a net outflow of over 5,000 bitcoins from miners in the last 24 hours, with selling pressure clearly rising. While the market screams bull run, some are quietly cashing out. Coinbase's base chain daily active addresses have topped 2 million, hitting a new all-time high. The Layer 2 space is still fiercely competitive, with users clearly migrating to lower-cost chains. EigenLayer's total value locked has surpassed $15 billion as the risk-taking narrative continues to heat up. Capital is hunting for new yields, but risks are scaling up at the same time. Addresses holding over 1,000 bitcoins have seen a net increase of over 30,000 in the past week. Whales are quietly accumulating. The market looks calm on the surface, but things are moving underneath. A certain meme coin surged over 200% in 24 hours, with discussion volume exploding on X. Capital is flowing back into high-risk sectors again, but its sustainability is questionable.
In the age of AI, the rarest skill might not be how many questions you can answer, but what kind of questions you can ask. Now, Lucia has been using Lobster for a while, and I've found that the most important thing is the commands and prompts you give it, because Lobster can execute tasks for you in a very short time, just like AI can give you a massive amount of answers in seconds. But if the question or the prompt itself is vague or low quality, then no matter how many answers you get, it's just noise. So what really sets people apart isn't the amount of information they have, but the direction of their questions and the direction of their prompts. A good question is essentially a form of thinking ability. It determines what kind of opportunities you see and what level of cognition you reach. People who know how to ask questions are often better at grasping the essence of things because they know what to doubt, what to probe, and what to ignore. In an era of information overload, answers have become very cheap, while questions are becoming very expensive. Remember, a good question is worth more than a good answer. Alright, that's the deep dive for this episode. Our channel is always focused on the core narratives and value discovery in the digital asset space. If you agree with our logic, feel free to stay updated with our latest news and turn on real-time notifications. To access a higher-level research space, you can follow our Jingji channel. From Monday to Friday, we'll also share some deep reviews of market cycles to capture certain opportunities within the trends. See you tomorrow.